Hello everyone, welcome back to Laptop Trader channel on YouTube. Again, my name is Philip. I'll be hosting this week's presentation. I'm here to share my trading experiences and give back to the stock trading community one video at a time. This channel is mainly for new traders or new investors, but all are welcome. We publish a monthly video which covers current markets and other technical trading topics. This week is a special edition of Laptop Trader. My email contact is laptoptraderphil@gmail.com if you have any questions. To share this channel, use @laptoptrader on YouTube. Just share that @laptoptrader, and that should take you right to my channel. This video is for information purposes only and should not be considered investing advice. Caution: trader, invest at your own risk. Most stock day traders lose money. Please protect yourself at all times. Any stock suggestions are up to you to decide if that is appropriate for you. Good luck and God bless. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. Let's do a quick market review. Okay, this week the S&P 500 ETF closed up another 2.35% at new all-time highs, continuing to be very bullish. Same with the NASDAQ QQQ ETF. Again, another up week, very bullish, up 5.5% on the week. That's extremely strong and overly strong, in my opinion. Dow Industrials ETF DIA up only 0.22% for the week. The Dow has essentially been going sideways now for 3 weeks in a bit of a base for consolidation here over the last 3 weeks. So that is neutral, in my opinion. We've got the Russell 2000 ETF, symbol IWM, up this week 1.75%. So that's very good for, I think, the overall market in general, as the Russell 2000 represents over 2,000 companies. So that's pretty good for market participation, up over 1.75% this week. New highs in the Russell. So again, very bullish in that regard. So let's get to a topic I wanted to discuss. And it's really a discussion on not only why public company valuation and market cap matters, but also a discussion on really how the stock market works. Okay, so this video is going to be longer than I thought, but it is a complicated subject, and I'm just going to try to answer all these questions that I had in my mind to the best of my ability. But this is how markets really work, kind of under the hood of how stuff really works. Now, what you choose to do with this information is up to you, but I think it's an interesting discussion. So, what is market capitalization or market cap? I'm going to answer all these questions. Why is market cap important? What is supply and demand? What does supply and demand look like in the stock market? How can we use market cap and valuation to judge a company? What factors affect valuation and market cap? What are some important news events that affect public companies, and which ones are just news or general information? How does the market treat different companies in similar industries? What is the role of supply and demand for public companies? Where would an investor likely put their money? How would they place their bets? How can I see where Wall Street investors are putting money to work? Where does my money go when I invest in my 401k savings plan or my pension plan, or if I invest in an index fund or a mutual fund or an exchange traded fund? So where does that money go? You know, if you're always working and you're saving and investing, where does that money end up? Why are index funds important, and how can I use them to compare or judge my stocks or my company's performance? And how has recent news affected three different companies in the same or similar industry? We're going to be taking a look at Amazon, FedEx, and UPS, which is kind of where I got interested in this topic with these three companies. Okay. Who am I? Who is Philip at Laptop Trader Channel? So most everything in this presentation that I'm sharing with you was gained knowledge from experience and trial and error in the markets. This information is my opinion and not knowledge from a school or an institution of higher learning or working on Wall Street. In fact, most schools will not teach this if they do anything at all. I am not an investment firm insider, nor have I worked at any financial institutions. My background includes time in the automotive industry, the food packaging industry, and the transportation and logistics industry. I would consider myself an average person in education, income status, and in basic career decisions that I have made. I do not have any advanced degrees in math, science, business, or engineering. One of my skills, for better or worse, is having the ability to break down complex systems into basic concepts and a good level of general intelligence. I'm not a genius. I got involved in the markets and investing to become my own investment manager, as I did not trust Wall Street or investment advisors in general, as I believe they have a difficult time in putting the client first, right? They always have, I think, their own incomes and their goals first, which is understandable, as that is how people operate. My interest in investing came from a desire to simply improve my financial performance over simply having a career and trying to improve my returns or my rate of returns or ROI for my investments. In doing so, I became very curious as to how investments actually work in the real world and why some investments go up and some go down. This opened up a long journey in the study of the markets. Why do they work? How do they work? Why even invest at all? Why not just give my hard-earned money to a financial advisor and hope for the best? I have read and applied several books on the subject. I have been investing since about the year 2000 and actively trading individual companies since about 2018. Now, having introduced myself, everything going forward will be as basic as possible for the new or curious investor, and therefore we will not exceed grade school level math, and yes, I too use spell check. My goal is to educate you, not intimidate you. Also, please understand that nothing in this presentation should be considered investing advice or a buy or a sell recommendation and is for information purposes only. If you need help investing, you should seek a qualified investment advisor to help you. Okay, so good luck. So, what is market capitalization? Market cap, which is what you'll usually hear abbreviated in the news, is simply the size of the company based on its value in the marketplace at any point in time. Another word tossed around in the media regularly is company value or valuation. These are all basically the same thing. Market capitalization is how much capital is in that investment at that time. So you'll hear that all the time in the media. Market cap, valuations. These are two common words in the investment world. So what is it? Market cap, or the size of the company, equals its share price times the number of shares outstanding in the market. This gives us the valuation of the company at that time, whether it's that day, that week, or that month, in real dollars. It's just basic math multiplication. So it's just share price times number of shares. So let's talk about how they may use this in the media. So if the news says Apple is valued at, let's say, $2 trillion, that is how they came up with that number. If the news has a headline that a company lost $1 billion in market cap today, the same formula applies. It just means the company or the stock was down today. Maybe a news article says that the company valuation is extended or overvalued. This is what they are referring to. Yes, it is real money gained or lost, but it is also relative to the company's size, and it is usually on paper for most investors, right? Stocks go up and stocks go down. The main thing is I want you to understand how a company gets its most basic value in investing terms. Don't be intimidated by big words or news headlines that are designed to make you feel less smart or fearful. Be informed, right? This eliminates fear. Wall Street and large firms want you to feel intimidated, so you feel you need to use them for their advice and for your investments. And that is how they make money by charging you fees to manage your money in an investment for you. Happens every day with investment funds. When you invest in a fund, you pay a fee for that service. It's not good or bad, it's just simply how it works. Okay, so market cap is just the size of the company based on their share price times the number of shares outstanding in the market. Simple. Why is market cap important? Well, market cap or valuation is quite important for investors and not so important for employees or managers at a company for two main reasons. This idea is not only a popularity contest, but also a democratic vote with investors' money. Investors, at the end of the day, tend to put their money where they feel it is best used. So, number one, size matters, and the larger and stronger the company is, and the more capitalized it is, the more money they have to use, and the better investment it tends to be over time. I compare this to the strong horse theory at the racetrack. Most of the money tends to go to the favorite or the strongest horse at the betting window. Everybody loves a winner and wants a sure bet. However, no bet is ever guaranteed. There's upsets. There is no sure bet at the track or on Wall Street. But the probabilities say the larger, stronger company will win the race. Just like the better sports team is favored to win the big game. So we're looking at probabilities, and we're looking at size of companies as a measure of how strong and how probable that company is to go up in value, just like at the big game. Secondly, new money that flows into the market will generally be placed in the largest cap stocks first. When you invest in a retirement pension or 401k or IRA plan, that money goes to work somewhere. It just does not sit there. It must be put to work or invested in something or in a company or companies within that fund. This is important because as the leaders emerge, unlike at the horse track, you can continue to bet more money on the leader of the race. So it's not static. This tends to prop up or push stock prices and valuations higher over time in the biggest and best and most financially well-off companies. This creates buying pressure and momentum for a stock to continue to move higher, and we can see this on a stock price chart, which we will get to later. Again, think of human emotion. Back several years ago when Mike Tyson was boxing, most of the bets were for Iron Mike, as he was the favorite or the sure bet in a fight in Las Vegas. A lot of people made a lot of money off of Mike Tyson fights. Investing in the stock market is a lot like that, only more dynamic, as it is an ongoing battle, and new companies are born, and old companies are replaced all the time. It is the essence of competition in the market. Later, when we get to the charts and some specifics, I will try to remain objective and let you decide. But I just want you to at least understand how investors look at an investment in public companies. This can become a cycle of a strong stock moving up tends to keep moving up, and a weak stock moving down tends to keep moving down because of the flow of money until something changes that would cause the reverse to happen. So the markets are not static like a traditional bet on a game or a race. And market cap definitely plays an important role in where those bets are placed. Okay? Supply and demand. So far, we have discussed market cap and valuation and why money flows into investments in the larger and stronger companies. This money flowing in and out of markets is supply and demand. We can see that as demand increases and the supply of the company's stock stays the same, people and investors, both big and small, are willing and able to pay more per share for a popular and valuable stock like Nvidia or Apple or Walmart. Remember, companies have an outstanding number of shares in the stock market or the market. It may be in the millions or even billions of shares, but it is still limited. As new money flows into the same stock, the price per share goes up. If an event or an earnings report or a news report affects that company in a negative way, then money may flow out of that company's stock. And if enough money flows out, the price per share will go down as demand increases. It's a pretty basic concept, and we see it every day or week when we fill up our vehicles with fuel. The price moves up or down based on current events. When I learned this about the stock market, it was like a light bulb moment for me. The mystery was solved. And that is why I chose to make this video, for you to learn too. So let's take a look at market cap real quick. This screenshot is from barchart.com, which is a service I use, but you can get the same information on your phone with a quick search of any public company. Now this is based on Walmart stock, and their current market capitalization or market cap right here is $1.36 trillion. Okay, so Walmart is over the $1 trillion market cap, huge company, right? And they have 7.970 billion shares outstanding. So even though it's huge, it says a limited number of shares. And then we can see some other information here about sales and income and price divided by sales ratio and price divided by cash flow ratio, price to book ratio. We can see they pay a dividend. You can see their next earnings date this month. We can see their most recent earnings, the previous earnings report. We can also see the PE ratio here, 49.35. And we can also see the earnings per share over the past 12 months. Just some basic information here from Walmart as to size of the company and what their current performance is. That's all I'm showing you there. So how can we use market cap or valuation to judge a company? Market cap or valuation tells us how large and valuable a company is relative to its peers or other companies in the same business or industry, and versus the markets in general. And so using market cap will be part of our comparative analysis. Secondly, we could use valuations to tell us if the current share price is attractive for a new investment or for continued investment. If the current valuation is high relative to its company's revenues and income, then we may say it has a high valuation or maybe even overvalued. If the current valuation is low relative to its revenue and income, then we may say it has a low valuation or may be undervalued versus its peers. The valuation can be anywhere in between, over or undervalued. Many times, however, companies are valued for a reason, and remember, the market is always right. A company with a low valuation may just be a poor company or a poor investment at this time. Nothing is static and things change. One idea I like to use is how is the company performing versus its peers and versus the market indexes in general. I like to use price performance to do this comparison using a percentage as my guideline. For example, if a company is outperforming the market by 10% and its peers by 50%, that would be a good sign of a strong company dominating their industry and performing well financially. Again, I repeat, the market is always right. I say this because if you enter an investment at the wrong time, you may be in the right company, but you could still lose money or have an underperforming or a losing investment. Anybody that has had a negative return or a losing trade knows what I mean. So let's take a look here at some competitors. This is just showing, what is it, five Walmart plus 5 competitors. So I pulled this up under the Walmart analysis on this platform. In this case, I used the weighted alpha as a comparison, and it closely compares weighted alpha in the 52-week change will be very closely correlated. Weighted alpha and the 52% week change are closely correlated. The alpha number simply puts more weight or emphasis on more recent price performance. Either one can be used to get a quick look or a comparison to other companies for a potential investment. This does not mean I would buy any of these companies at this time, but I would certainly eliminate the bottom 3 for my interest at this time. I am just not interested in a weak horse at this time. So we can see whether you use 52-week percentage change or weighted alpha, we can see that the first company, Ingalls Markets, has a weighted alpha of plus 38. Walmart has a weighted alpha of plus 36.5. Village Supermarkets has a weighted alpha of plus 27. Okay, this is not a percentage, this is just an alpha, it's just a number. If we actually want to look at the percentage changes, we can see the top one, Ingalls, is up over 40% over the past 52 weeks. Walmart, the largest retailer, is up well over 31%. And Village Supermarkets is up over 19.5% over 52 weeks. So those are all performing very well. And, even this fourth one is actually doing okay. The bottom 2, not so much, right? So Kroger has actually went down over 8% over 52 weeks. And Weiss Markets, again, down almost 20% over 52 weeks. So these bottom 2, that's why I would eliminate these bottom 2 from even consideration. They're just not performing versus their peers. And so those, unless they made a significant turnaround, then I would not consider those at this time. Again, not that I would necessarily consider any of these at this time for investment, but this is just using some comparative basic analysis. How are companies performing, whether it's over the past 52 weeks or whether it's over the past 6 weeks. We can use some sort of comparative analysis. What factors affect a company valuation or their market cap? Any and all factors can affect valuation, including, but not limited to, recent news or events, recent or upcoming earnings reports, forward-looking guidance on revenue growth or profitability, interest rates, government policies, trade policies, dividends, share buybacks or issuing new shares, Are there any new competitors in a certain group or industry disrupting the group, the general economy, etc.? More specifically, earnings per share. Is it growing or declining? 2. Is the industry new and exciting and growing, or is it an established industry that's been around for a long time? Are there new products or services from my investment? Is the company growing? Is my company in the top of its class? What do the ratios tell me, like the PE ratio or the price to sales ratio? Are those growing, or are they acceptable ratios? Is my potential investment popular and in demand or not? What do the charts tell me at this time? Growth is the number one word on Wall Street. Is my company growing sales, revenues, earnings, net income, net margins, market share, dividends, and other metrics like debt load and cash flow? Is my company growing? Is my company or investment financially sound, or is it having a tough time paying its expenses? Are incomes outpacing expenses or debts? Is any other competitor disrupting my industry or my company? These are some of the questions we ask as investors to determine our commitment to our current investments and whether we want to engage in a new investment. Here we can see when it comes to market cap and where these companies are ranked when it comes to the S&P 500. So in this example, we're comparing FedEx, which is ranked at number 137 in the S&P 500 at this time, and UPS, or United Parcel Service, ranked at number 149. I'm bringing this up for a reason. Within that ETF, there are 506 holdings in the S&P 500 ETF SPY. The percentage in the top 10 of this ETF, right, so the top 10 companies comprised over 39% of the funds in this ETF. Amazon is ranked number 4 with 4.21% of all the money within this fund is in Amazon. At the top of the leaderboard is NVIDIA with over 8% of the fund's money in NVIDIA. And then you see Apple, Microsoft, and Amazon number 4, then Alphabet or Google number 5, right, and down the line. These should all be fairly recognizable companies. Like Tesla is also in the top 10. So when we look at that and we go back to FedEx, which is down at number 137, 0.13% of the money within the S&P 500 is in FedEx, right? And we look at United Parcel Service, 0.12% of the money in the S&P 500 is invested at this time in UPS. So there's quite a difference there between UPS, FedEx, and Amazon as far as where they're at in market cap or valuation. All three companies are extremely well run, huge companies, but the size of Amazon can be overwhelming. So that is what I'm trying to show you there. Now, again, weighted alpha is just simply a measure of how much a stock has risen or fallen over a 1-year period with a higher weighting for recent price activity, which is calculated as of the previous close. So that's all that weighted alpha is. And we can see here on the list, just different weighted alphas where, for example, eBay has a 55 weighted alpha. Amazon has a 44 weighted alpha. And UPS has a 4.99 weighted alpha. So it's just a measure of performance as far as how much the stock has risen over the past year. Okay, so it's just for information. It's just a way that we can measure performance. It doesn't have as much to do with market cap, but again, many times the big money will flow into stocks with the highest market cap, like Amazon, NVIDIA, Meta, Tesla, etc. first, because and you can see that the largest company 8% of the money is flowed into NVIDIA Corp because they're just so big and so strong. Again, that would be the strong horse at the track, or the strong fighter in the fight. Now, here I've created a list of stocks of basically a quick transportation list of stocks. And I simply clicked on this weighted alpha, and that ranks these stocks based on weighted alpha. So at the top we have a company RXO, then JB Hunt, then FedEx, down the line Werner, Amazon, and again UPS is at the bottom based on recent performance over the past year. So again, just a little comparative analysis between FedEx, Amazon, and UPS. Then on the next slide, I chose to sort and segregate the companies based on the actual 52-week percentage change. This is closely tied to weighted alpha, but this is more of a just the direct percentage change over that period of time, over 52 weeks. Now we can see XPO is up over 82% over 52 weeks. FedEx is up over 72% over that same period of time. And Amazon is up almost 42% over that same period of time. And UPS is up just under 4% during that same period of time. So that's the change in the stock price over 52 weeks, right? So again, another relative performance based on a 52-week change. So this is all relative, but still good information. So we're just comparing these three companies right now based on, so far, alpha, 52-week change, market cap, and then here's another change that's a little more closely related to this alpha number, the 5-day change, right? So you can see at the top, RXO has a 5-day change of just over 11%. Amazon went up 1.65% over 5 days. Then we've got FedEx is down 3.83% over 5 days. And UPS down 6.31% over the same period of time. Again, another direct analysis comparison for these companies. So just being objective. Now let's think about this. What are some important news events about my company or the companies I may be interested in? News events are generally events that have already happened and are being reported on, but how do they affect my investment at the time? How does the market treat companies in similar industries? Well, the market can treat different companies quite differently based on their market cap and the general company outlook for the future. Remember, it is a dynamic race or competition over time. A more well-funded or capitalized company that is higher in the market rankings may perform much better than a less popular or smaller company. Remember the strong horse theory and how the bets are placed. Where would an investor place their money or their bets? Which company or companies would you invest in as an investor with your hard-earned money? Start thinking like an investor. Even if you only buy and invest in a mutual fund or an index fund like the S&P 500 index or an ETF fund like the SPY fund. How can I see where Wall Street firms are putting money to work? Can we see this? Is it possible to track money in or out of a market? I believe yes. We can see this in price charts with volume. And in using market cap and knowing the largest companies generally get more money, we can add the two together and see markets or stocks going up or down in a trend. One thing I found helpful with volume is using volume times price to figure out in real dollars how much money is being traded. More actual dollars being traded or invested is a huge signal in my opinion. So if we see a lot of money flowing into a certain company, that's a huge clue. Where does my money go when I invest in a fund? When you make an investment in a fund through a 401k or a pension, for example, it goes where the fund manager is directed to go. Usually it gets dispersed into the largest and best companies. These funds are generally, not always, weighted toward the top companies receiving a higher percentage of the new money being invested, which I've already shared that with you, that the S&P 500 is weighted. But you do not directly get to choose where these funds put the money. You give them your money as an investment, and the fund managers direct that money into these different investments. Why are index funds important? Index funds are fairly new in investment in human history. When John Bogle founded Vanguard Funds, he really changed investing for the average people forever. There have been several books written on him and the company. Basically, when you buy or invest in an index fund or an ETF index fund or a total stock market fund, you place your money in a large basket of the best stocks, and it tracks or indexes to the performance of the overall market. It is the simplest and easiest way to grow your money over time in a predictable and relatively safe way. The average return over time is over 10% annually, and yes, you can get rich over time at 10% average rate of return. So index funds have become very important, and this was not always the case before, I believe it was the 1970s. But you guys can look that up for yourself. But this is also very important because if you pick individual stocks or trade or invest in, this gives us a benchmark of performance. It makes no sense to take individual stock risk like Enron or any other company if we can't beat a 10% return over time. It's just too easy to buy an index fund and sleep well at night. This is passive investing. Before index funds, it was common to have just what were called load funds, or funds that would charge high fees, and certainly funds that would underperform and wouldn't even get you a return. So this is a big deal, between the beginning of the market and probably the 1970s. How has recent news affected three companies in the same industry or business? Now, let's get to the reason why I started this discussion in the first place. Recently this year, there has been a shakeup in the order in the logistics and air and package delivery industry. We can see this in not only market cap rankings, but also in recent news events. If you own or work at any of these companies, this is not an attack on them or a recommendation to invest in them. It is merely an objective look at how they are performing in the market at this time. I think this is a good study of how things work in the real world, and I wanted to share this opinion and information if you care to learn about investing and or trading. So here's a recent news release. May 4th this year, Amazon launches Amazon Supply Chain Services, opening its logistics network to all businesses. Any business can now move, store, and deliver everything from raw materials to finished products quickly and reliably using the same supply chain that supports Amazon.com, right? Retail, wholesale, and commercial businesses of all sizes now have access to the same logistics capabilities that have supported Amazon's growth for decades. Leading brands, including Procter & Gamble, 3M, Lands' End, and American Eagle Outfitters, are among the first to sign up for Amazon Supply Chain Services, now relying on Amazon's logistics network across their supply chain. So that's important because so far Amazon has, up until now, has simply only moved orders, by Amazon, for Amazon, and through Amazon to retail customers. Then we had another news story on May 4th. FedEx, RXO, and United Parcel Service shares are falling, and what you need to know. So that's kind of a big headline, because after this announcement came out on May 4th at 6 a.m., this story came out at 3 p.m. Then we had this news, what Amazon Supply Chain Services launch means for Amazon stock. So Amazon's new service bundles warehousing, freight forwarding, customs brokerage, transportation, and last mile delivery into a single unified enterprise. The company's logistics footprint is formidable, encompassing more than 80,000 trailers, 24,000 intermodal units, and over 100 aircraft, representing infrastructure built over years of internal investment. And then it goes on to say that, why they did that, okay? Why, and then this came out that day too. Why is it super bearish for UPS shares? Amazon's release confirms that Amazon Supply Chain Services isn't just targeting small merchants, but the lucrative business-to-business shipping market as well, a high-margin segment that's been a key profit driver for both UPS and FedEx. So, and that's all UPS and FedEx do. They just move goods from point A to B. They don't have Amazon Web Services or Amazon.com or e-commerce. But the threat to UPS shares is particularly acute in the small medium-sized business space, which United Parcel Service has been targeting as a core growth market to replace lower margin Amazon delivery volumes. So earlier in last year, UPS is trying to move away from Amazon. And it says UPS had been voluntarily reducing its Amazon delivery volumes by some 50% between early 2025 and mid-2026, a strategic move to shift towards more profitable deliveries in healthcare and small business markets. CEO of UPS, Carol Tomey, had characterized 2026 as an inflection point following this deliberate pullback, during which UPS eliminated roughly 48,000 positions and closed 93 facilities in 2025. But the Amazon Supply Chain Services launch now threatens to undercut the very market the New York Stock Exchange listed firm was counting on to replace lost Amazon volumes. So you have kind of a double thing there going on. You got UPS trying not to haul as much Amazon, and now Amazon trying to get involved in UPS's core business. Here's another story from a different author. Just a headline on May 6th. Ignore the Amazon trucking noise and buy UPS stock for its high yield, near 7%. So UPS pays a very generous dividend to its investors, whereas I think Amazon pays no dividend and maybe FedEx pays a small dividend. So that was another headline about this industry. So as you can see, as investors, we can look through some news events. If we're not involved in these industries, we can get a pretty good feel as to what's going on. We won't have all the information from somebody on the front lines, but could still get a decent amount of information just from the news about UPS stock. Founded in 1907, UPS is one of the world's largest logistic companies, generating over $88 billion in revenue in 2025, while providing integrated transportation and supply chain solutions across more than 200 countries and territories. The company operates with a strategy centered on customer service, workforce leadership, and innovation, supported by an global employee base of roughly 460,000 people. So that's a huge company with a global footprint. And then it goes on to say what else they do and why they do it. So I won't keep reading that. You guys can read that for yourself if you want to. It again reiterates in this article that at the heart of the transformation is UPS's deliberate shift away from lower profit Amazon-related volume towards more lucrative segments, a move designed to strengthen margins, improve the quality of revenue, even if it results in slower package volume growth overall. So they're trying to increase their margins, which is important for investors. Then we had, I typed this, and if you type this into Google, you would get this. FedEx overtakes UPS's valuation or market cap. So as of March 2026, FedEx has surpassed UPS in market cap for the first time since 1999, with valuations hovering around 84 to 85 billion, marking a significant historic shift in the delivery industry. This reversal was driven by investor confidence in FedEx's cost-cutting and AI initiatives, contrasting with a 40% decline in UPS's valuation over the past 2 years due to labor costs and falling volumes. And again, they just made this valuation milestone where FedEx passed UPS in market cap in March 2026, with FedEx valued at approximately $84.9 billion and UPS valued at $84.86 billion at the time of this initial flip. So those two are very close as far as size of company when it comes to market cap. And then it goes on, you guys can read that for yourself. It just goes on. You can dive into that if you wish. But I think it's a fairly significant deal when one company passes others in market cap. It shows one is kind of performing, or at least in Wall Street terms is performing, and one is going the other way, right? So why technical or chart analysis matters. So let's get into some charts here and why. I believe that most or all information about the markets in general and most stocks in particular is already reflected in the price of a stock. There will be cases where there is a surprise, usually if a stock is very small in market cap and it is not widely followed or has little to no news reporting. It may be a great opportunity to get in early before everyone knows about it. And Netflix, before it became a streaming service, comes to mind, right? Netflix used to just be like a DVD service, but then they became streaming and they went huge. On Wall Street, there are some really smart and educated people who are well paid and motivated who analyze and scrutinize these public companies as a full-time career. I don't think I am any smarter than they are, and I don't have as much time as they do to analyze any one company or industry. Therefore, I have found by using price charts I can garner enough information about the markets or stocks to make a quick and effective decision for myself. I have satisfied myself over the years that the charts are true information at any point in time and in any time frame because of the flow of money and supply and demand. In other words, news stories may or may not be true or even accurate, and we know CEOs and people in general lie to promote their best interests. But when there is money flowing in or out of a company, you can't hide that. It shows up in a stock price chart. Now, I'm not saying here that Amazon or UPS or FedEx CEOs are lying. I'm just saying it's happened in the past. And a great example of that would be when Enron suddenly went out of business several years ago. It was the favorite stock at the time. Many people invested heavily in Enron. Eventually, the leaders and CEO of the company could not lie anymore, and it came crashing down. The truth came out. If you had looked at a chart at the time, you could have seen that the stock was well overvalued and overbought, and at least could have reduced your investment or your position size down to a level that would not be catastrophic to your financial health. Some employees at the company had not only their jobs there, but also their entire net worth and savings in Enron stock. It's not a good idea to put all of your eggs in one basket because we just don't know. Now, let's take a look here at some charts. Here's Amazon's chart. This is a chart of price over a 5-year period, and each bar, each green or red bar or green or red candle represents 1 month of pricing activity. When we look from left to right, we can see here there was a kind of a flat period. We can see a down period into 2022. Then after that, this has kind of been in this, pretty slight uptrend, and recently made some new highs. That's what this little half circle thing means. Price moved up, made a new high as of this month. So Amazon making new highs and generally overall positive uptrend. And these 3 lines on the chart, this green, blue, and purple line, are just simple moving averages over 12, 24, and 36 months. So, the price is pointing up. These 3 lines are pointing up. That's basically how we determine the stock is in an uptrend or the company is performing and price is going up. Therefore, valuation is going up. Therefore, their market cap is also going up. Excuse me. Now, let's get to the next, FedEx Corp. A little bit different looking price action, a little bit different looking chart where, FedEx here was in a downtrend where price was going down from, 2021 into, looks like late 2022. Since that time, it kind of went up sideways, pulled back in 24 into 25. Since that time, it's really had a nice move up or an uptrend recently in FedEx Corp stock made a new high last month. This month it's turned red, but overall making new highs up here to the right would be a positive sign for FedEx as far as the market cap, valuation, and stock price in an uptrend goes. Very strong year actually over the last year for FedEx. Let's get to the next chart. UPS, United Parcel Service, different looking chart where we have left to right, we had kind of this plateau into mid 2022, and since that time, UPS has been in more of a downtrend. Recently, yes, it's popped up, kind of went up and sideways, but overall, our green, blue, and purple moving averages are pointing down. So UPS has been in a downtrend versus, FedEx and Amazon in an uptrend. So you can see all these charts, the pricing of these companies, much different, right? And in this case, UPS, because even though maybe they still are larger than Amazon and FedEx in that specific niche of parcel delivery, they have lost market cap. They have lost valuation because the price of the stock has been going down. Therefore, the market cap has been going down. That's why, in my opinion, why FedEx is overtaking UPS because of this, just because of the price of the stock. And I want to throw this in here too as far as the comparative analysis, because I would compare Amazon to several different companies, and I think eBay would be a fair comparison. That's really what Amazon originally was an e-commerce, buying and selling platform, and so was eBay. And we can see eBay left to right had a sideways move, downtrend, sideways trend, and then uptrend since mid 2024. Very good looking chart for eBay, right? Very positive, new high this month, right? We've got the short, medium, and long-term averages pointing up. So eBay has had a very nice couple of years. So as a comparison to Amazon. And we can also compare Apple, in my opinion, to Amazon, right? Apple has phones, smartphones, tablets, computers, and they have, music services like Apple with the Apple Music, and they've got they make their own products, they make their own chips for their products, and they're a very diverse, well-run company, right? And so is Amazon. I would compare Amazon because I believe Apple also has Apple TV, like a paid streaming services, whereas Amazon has Prime, logistics, and so I think those are two fair comparisons to compare, also based on market cap. Amazon and Apple have a very comparable market cap or size of the company, but we can see Apple over time kind of goes up, pulls back, goes up, pulls back. This is kind of how a large company normally works. You do have these periods of price moving up, price moving down, then price making new highs, and then price moving down. This month, Apple just made a new high. And again, all the moving averages are pointing up. So Apple, very positive over the 5-year period versus all of these companies. We could also compare again, I think, Netflix to Apple and Amazon, right, and to other streaming services, right? Apple has Apple TV, Amazon has Prime, Netflix is its own streaming services. That's all they do. They don't do any actual hard products or services. They just do streaming. But since the others stream, then I think this is a fair comparison to those also. And we can see Netflix since here, mid 2022, big uptrend for Netflix. Last time Netflix made a new high, though, was about last year or a year ago. Since that time, Netflix has been in a downtrend, maybe recently a sideways trend, but so the other companies, when we look at these, Netflix is moving down, Apple's moving up, UPS is moving down, FedEx recently is moving up, and Amazon over time has been also moving up. So I think these are very fair comparisons, just simply using price, volume, market cap, size of company, etc. And yes, we can see this on the chart, right? Netflix would not be moving down if money was still moving into Netflix. So money has been coming out of Netflix, right? Money has continued to go into Apple over time because Apple just made a new high, right? If money was not flowing into Apple, it wouldn't be making new highs. Money would not, eBay would not be making new highs if money wasn't flowing into eBay. And you can see all this green volume down here. Look at all this volume, green, 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 mostly green, right? When we look at UPS, is money flowing in or out of UPS? Well, on this chart over this 5-year period, money has been flowing out of UPS, driving the price down. Now, more recently, since end of last year, we can see some inflow of money into UPS over this 5-month period between probably December, November, and into this new year. So things are not always static. Money flows in and out. FedEx, money recently has been flowing into FedEx. I know this because price has been moving up and it just made a new high last month. Again, we can see Amazon money consistently has been flowing into Amazon over this 5-year period because Amazon just made a new high. So that's all I want you to get from these charts is we can see, in my opinion, money flowing in and out of these stocks and these markets. I hope that helps you out. What factors can affect the company valuation or market cap? Right, any and all factors. I want to remind you of this. This is the same slide from earlier. Any and all factors can affect valuation, including but not limited to recent news, recent upcoming earnings reports, forward-looking guidance you'll hear on revenue growth or profitability, interest rates, government policies, dividends, share buybacks, or issuing new shares. Are there any new competitors in a certain group or industry disrupting the group, general economy, etc.? More specifically, right, recently, we found out that Amazon is going to enter into the logistics space and open up their network to other businesses, right? So number 9, is any other competitor disrupting my industry or company? I think that's why it's important and a big deal that Amazon is trying to get into that niche of package delivery. Again, these are some of the questions we ask as investors to determine our commitment to our current investments and whether we want to engage in a new investment. Okay? Anyway, that's the end of this presentation. In closing, I hope I have increased your knowledge and understanding of the markets. Maybe even ignited some curiosity for yourself, just as someone once did for me. If nothing else, I hope it at least makes you a more confident investor, and I wish you the best in your future and in your careers. I don't think it is enough to simply go to work every day and hope for the best. Please get your money working for you and your future. If you don't invest in anything, then your money loses value over time due to inflation. Yes, you are taking a risk, and stock markets do go up and down, but no risk, no reward. You don't have to invest in the stock market, but over time it has been one of the best investments out there. Good luck, and God bless. Bye, guys. Have a good day.